Today, a new financial world order, or just a ruble gold gamble? Hello again, it's Martin North from Digital Finance Analytics. Welcome to today's posts covering finance and problem news with a distinctively Australian flavour. So the question is, are we at the edge of a new financial world order triggered by the Ukraine conflict and Russia's move to gold-back the ruble, or not? Well, we have been noting the fact that both China and Russia have been adding to their gold holdings in recent years in a deliberate strategy to be able to insulate their currencies in times of crisis from the mighty US dollar. Since 2005, Russia has more than tripled its gold holdings, so the Russian Federation has the fifth largest officially reported gold reserves after the USA, Germany, Italy and France, and by the way, in comparison, Australia is, well, nowhere. Now, amid all the noise and fury from the Russian-Ukraine conflict is a development which may shake the international financial system to its core, because the Russian central bank restarted buying gold from banks, and it will pay a fixed price of 5,000 rubles, or $52 per gram, between March the 28th and June the 30th. The central bank, which suspended gold purchases from banks in mid-March to meet increased demand for the precious metal from households, said the resumption of buying would help ensure sustainable supply and the uninterrupted functioning of gold producers. Now, the current decision, of course, was made against the background of new Western sanctions against Russian banks. The purchases are a clear statement against the dollar rule, especially when combined with the fact that more than half of all US treasuries have been dumped since January 2014. So, when did Moscow start planning a gold-backed ruble? Well, economist Jude Walensky had recommended this as early as 1998 in a sensational editorial in the Wall Street Journal. Only a gold-backed ruble could free Russia from the debt crisis and establish international acceptance of the Russian currency, the article said at the time. And it seems that Vladimir Putin has taken this idea up again 2 decades later. Put simply, this has profoundly altered the international trade and monetary system by linking the Russian ruble to both gold and commodities. By offering to buy gold from Russian banks at a set price of 5,000 rubles per gram, the Bank of Russia has both linked the ruble to gold and, since gold trades in US dollars, set a floor price for the ruble in terms of the US dollar. The Bank of Russia's move to link the ruble to gold and link commodity payments to the ruble is a paradigm shift that the Western media has not yet really grasped. As the dominoes fall, these events could reverberate in different ways: increased demand for physical gold, blow-ups in the paper gold markets, a revalued gold price, and a shift away from the US dollar. And it may also increase bilateral trade in commodities among non-Western countries in currencies other than the mighty US dollar. Now, Rowan Manley of bullionstar.com wrote a compelling Q&A for RT.com, which of course these days is hard to access, but he also made it available more widely. He said that we can see this linkage in action since 25th of March, when the Bank of Russia made the fixed price announcement. The ruble was trading at around 100 to the US dollar at the time, but has since strengthened and is nearing 80 to the US dollar. Why? Because gold has been trading on international markets at around 62 US dollars per gram, which is equivalent to about 80.5 rubles, and markets and arbitrage traders have now taken note, driving the ruble-US dollar exchange rate higher. So the ruble now has a floor to the US dollar in terms of gold, but gold also has a floor, so to speak, because 5,000 rubles per gram is 155,500 rubles per troy ounce of gold, and with a ruble-US dollar floor of about 80, that's a gold price of around 1,940. And if the Western paper market gold markets in London and COMEX try to drive the US dollar gold price lower, they will have to try to weaken the ruble as well, or else the paper manipulations will be out in the open. And additionally, with a new gold to ruble linkage, if the ruble continues to strengthen, for example, due to demand created by obligatory energy payments in rubles, this will also be reflected in a stronger gold price. So he says, what does this mean for oil? Well, Russia is the world's largest natural gas exporter and the world's third largest oil exporter. And we're seeing right now that Putin is demanding that foreign buyers, importers of Russian gas, must pay for this natural gas using rubles. This immediately links the price of natural gas to rubles and, because of the fixed link to gold, to the gold price. So Russian natural gas is now linked via the ruble to gold. The same can now be done with Russian oil. If Russia begins to demand payment for oil exports with rubles, then there will be an immediate indirect peg to gold via the fixed price ruble-gold connection. Then Russia could begin accepting gold directly in payment for its oil exports. In fact, this can be applied to any commodities, not just oil and natural gas. So what does this mean for the price of gold then? Well, by playing both sides of the equation, linking the ruble to gold and then linking energy payments to the ruble, the Bank of Russia and the Kremlin are fundamentally altering the entire working assumptions of the global trade system while accelerating change in the global monetary system. This wall of buyers in search of physical gold to pay for real commodities could certainly torpedo and blow up the paper gold markets in London and on the COMEX. The fixed peg between the ruble and gold puts a floor on the ruble-US dollar rate, but also a quasi-floor on the US dollar gold price. But beyond this, the linking of gold to energy payments is the main event. While increased demand for rubles should continue to strengthen the ruble-US dollar rate and show up as a higher gold price due to the fixed ruble-gold linkage, if Russia begins to accept gold directly as a payment for oil, then this would be a new paradigm shift for the gold price, as it would link the oil price directly to the gold price. For example, Russia could start by specifying that it will now accept 1 gram of gold per barrel of oil. It doesn't have to be 1 gram, but it could be a discount offer to the current crude benchmark price so as to promote its take-up. For example, 1.2 grams per barrel. Buyers would then scramble to buy physical gold to pay for Russian oil exports, which in turn would create huge strains on the paper gold markets of London and New York, where the entire gold price discovery is based on synthetic and fractionally backed cash-settled unallocated gold and gold price derivatives. So what does this mean for the ruble then? Well, linking the ruble to gold via the Bank of Russia's fixed price has now put a floor under the ruble-US dollar rate and therefore stabilised and strengthened the ruble. Demanding that natural gas exports are paid for in rubles and possibly oil and other commodities down the line will again act as a stabilisation and support. If a majority of the international trading system begins to accept these rubles for commodity payment arrangements, this could propel the Russian ruble to become a major global currency. At the same time, any move by Russia to accept direct gold for oil payments will cause more international gold to flow into Russian reserves, which will also strengthen the balance sheet of the Bank of Russia and in turn strengthen the ruble. Talk of a formal gold standard for the ruble might be premature, but a gold-backed ruble must be something that the Bank of Russia has considered. So what does this mean for other currencies then? The global monetary landscape is changing rapidly and central banks around the world are obviously taking note. Western sanctions, such as the freezing of the majority of Russia's foreign exchange reserves, while trying to sanction Russian gold, have now made it obvious that property rights on foreign exchange reserves held abroad may not be respected, and likewise that foreign central bank gold held in vault locations such as the Bank of England and the New York Fed is not beyond confiscation. Other non-Western governments and central banks will therefore be taking a keen interest in Russia linking the ruble to gold and linking commodity export payments to the ruble. In other words, if Russia begins to accept payments for oil in gold, then other countries may feel the need to follow suit. Look at who, apart from the US, are the world's largest oil and natural gas producers: Iran, China, Saudi Arabia, UAE, Qatar. Obviously, all of the BRICS countries and Eurasian countries are also following all of this very closely. If the demise of the US dollar is nearing, all of those countries will want their currencies to be beneficiaries of a new multilateral monetary order. So what does that mean for the US dollar then? Well, since 1971, the global reserve status of the US dollar has been underpinned by oil, and the petrodollar era has only been possible due to both the world's continued use of US dollars to trade oil and the USA's ability to prevent any competitor to the US dollar. But what we're seeing right now looks like the beginning of the end of that 50-year system and the birth of a new gold and commodity-backed multilateral monetary system. The freezing of Russia's foreign exchange reserves has been the trigger. The giant commodity-strong countries of the world, such as China and the oil-exporting nations, may now feel that now is the time to move to a new, more equitable monetary system. It's not a surprise. They've been discussing it for years. And while it's still too early to say how the US dollar will be affected, it will come out of this period weaker and less influential than before. And of course, currency systems have always been in a state of flux, but it had also become apparent quite quickly each time that gold was needed above all else to give confidence to a new currency. And of course, this in the past led to the establishment of the International Monetary Fund in July 1944 as a so-called Bretton Woods system to manage, among other things, unbalanced trade balances between countries through currency adjustments. By 1971, the price of gold per troy ounce was set at around $35, but with a stroke of a pen, Nixon repealed this historical gold standard in August 1971. Nixon justified the drastic step with speculations against the US. In reality, though, the US had overextended itself financially through the wars in Korea and Vietnam and had to put too many dollars into circulation to finance the wars. Confidence in the reserve currency dwindled. Central banks around the globe exchanged their dollar reserves for gold, and France in particular drove this movement. The threat of a sell-off of US gold reserves loomed, so Nixon had to pull the emergency brake. 2 years after the fateful separation from gold, all exchange rates to the dollar were released. From that point on, the world's reserve currency, the dollar, has no more than a paper currency that could be multiplied at will. After a very turbulent decade, the unbacked US dollar was finally able to assert itself as a global trading and reserve currency in the mid-1980s, even without formal gold backing. But since then, the US dollar, or interest-bearing US government bonds, developed as an international reserve currency. Central banks have since been able to earn interest rate profits by holding the bonds. In contrast, the US central bank has always been able to profit from the additional demand for US debt securities, which could be realized by issuing significant bank money globally. But now this worldview focused on the US and its currency seems to be crumbling. There are serious indications that this is not only in the geopolitical arena, but the US dollar is also coming under increasing international pressure. In the short term, the ruble is back and all post-conflict losses are erased. It's incredible what gold backing can do. Until June the 30th, the costs of precious metals in such transactions will be 5,000 rubles per gram of gold. This is 17% lower than the book price for refined gold on March the 25th. But if 5,000 rubles per gram is the market price, the sale would be worthwhile for the Russian banks and would further appreciate the ruble against the dollar or euro. However, this also means that Russian banks will not sell foreign currency in cash until September the 9th. Withdrawals of foreign currency deposits will be limited to $10,000. The rest will be paid in rubles at the market rate on the day of withdrawal. Now, this does not necessarily affect ordinary citizens, but foreign companies operating on Russian territory. The established price levels allow us to ensure stable gold supply and smooth functioning of the gold mining industry this year. After this period, the price of buying gold can then be clarified, the Russian central bank said. And as noted in the message, the regulator is returning to metal purchases on the domestic market to ensure a balance between supply and demand. Major precious metal trading companies around the globe see the dollar losing importance as the global currency due to those US sanctions. And in fact, the Biden administration's economic sanctions against Russia could come a significant boomerang, with this and other measures heralding the end of global dollar dominance. If many central banks worldwide come around to the idea that it is no longer necessary to hoard large dollar reserves, a colossal exchange rate collapse could also be programmed. The inflationary, monetary and debt policy that Biden is resolutely tightening would then devastate the US economically with the force of a hurricane, and with it, Western capitalism. Sberbank, Russia's largest financial institution, reported that demand for gold and palladium has quadrupled in the past few weeks. And meanwhile, Russia's Ministry of Finance also referred to gold as an ideal alternative to the US dollar. And Russia is also considering accepting Bitcoin for its oil and gas exports and being more flexible in general regarding payment options with friendly countries. So, in summary, here's Seeking Alpha's take. There is a price differential between Brent crude and Urals crude. In other words, the difference between the price of oil outside Russia and oil inside Russia. True, the two grades of oil are not exactly the same, but the arbitrage has clearly exploded since the Ukraine invasion began. The extreme differential is obviously because of sanctions that cut off much of Russian oil markets to the rest of the world. And so whatever Russian oil can get through the firewalls is offered at a major discount. But the United States and its allies also are sanctioning Russian gold. And what does that do? It creates the same sort of price differential and arbitrage opportunity. Russian gold is much cheaper than non-Russian gold now because Russian gold is cut off from the rest of the gold market, and there's risk of retaliation if you get caught buying it from Russia. The London Bullion Market Association has already banned Russian gold from its registries. And so if you're a Russian bank and you have some gold and you can't sell it to someone out of the country except at a steep discount, and the Bank of Russia is offering to buy it from you at less of a discount, that's still a premium for you. And the Bank of Russia splits the difference, increases its gold reserves, and in a way stabilizes the ruble. The next step in this process is to strengthen the ruble internationally. To do that, Russia has announced that it will only sell energy for rubles in unfriendly countries. In other words, countries sanctioning Russia. By doing so, demand for the ruble picks up, which could eventually turn the 5,000 ruble discount internationally into a premium, encouraging more gold flows into Russia internationally as well, and further draining the West of its gold reserves in favor of Russia. This would stop the domestic flow of gold into the Bank of Russia, but it would encourage international flows, the next logical step after domestic supplies run dry. So why can't the West see that this is happening? Because they're myopic. The mainstream financial press is so focused on the Russians selling gold angle because they're deeply Keynesian, and they don't understand that gold is money rather than the paper that they print, and that the paper only has value because it is still exchangeable for gold. True, Russia eventually needs to sell gold at some point to get stuff it needs, but Russia can do this without actually moving any of its gold. How so? It can simply declare the ruble a hard gold substitute at a fixed exchange rate. In other words, a gold standard. But before it does that, it must first make sure that it has the required reserves if tested, which it's now doing by splitting the arbitrage offered by Western powers that have sanctioned its gold and cut it off from global markets. The Bank of Russia must also make sure its monetary policy is tight enough, now at 20% interest rates, to hold the line. Then it can insist on payment of Russian commodities in rubles, now hard gold substitutes. That's the beauty of a money substitute, aka a gold substitute in a gold standard system. The currency takes the place of gold, so you don't have to physically move the stuff, which is a pain and expensive. Western financial thought has this idea that if they cheapen Russian gold by sanctioning it, they're hurting Russia by lessening the amount of stuff they could potentially buy with that gold. In fact, they're actually helping Russia by encouraging gold inflows into the country and making it much cheaper for the Bank of Russia to amass much more gold to back the ruble at a credible rate when the time comes. And when is that time? Well, nobody knows for sure or if it will ever come indeed. But the 5,000 ruble gramme gold window closes on the 30th of June. And what happens then? Does the ruble become a fully backed gold substitute? Who knows? But this is a really big thing that's going on here. And as I said at the top, I'm not sure that those in the West get the full picture. Because if indeed gold is reasserted in some way, then the US dollar's role could be devalued. But also I'd make this point. There are people out there who believe fundamentally that gold has to come back and drive the fundamental value of currencies around the world. They are, of course, preaching the gospel here. There are others that believe the US dollar is going to be so strong and so entrenched globally that it will always dominate. They might be wrong too. Or is there another school of thought that really says there's a lot of chaos here, everybody's pulling in a different direction, and as a result, the financial markets could continue to be significantly disrupted, but without any clear future direction? I'd remind you of this, that a couple of years ago, there was an argument that one future potential substitute for the US dollar could be a stablecoin digital currency. And I have the view that we may well see that card being played quite soon too. So, to answer my own question, it is actually too soon to know whether this is the fundamental demise of the US dollar or merely a blip on that journey. But it does seem to me that the role of gold and its connection with currency is going to be tested in the weeks and months ahead. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.